Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk this afternoon, we have John Wu, president of Ava Labs, Will Peck, head of digital assets at WisdomTree, Barnaby Nelson, founder and CEO of ValueExchange, and Adam Sullivan, CEO of Core Scientific. They join me to discuss increasing institutional adoption of digital assets and bridging the gap of TradFi and DeFi. Gentlemen, it's great to have you with us. Welcome to TradeTalks. And before we get into our core conversation of bridging that gap, clearly we have to cover the news of the year, basically. Finally getting the approval for a spot Bitcoin ETF in the US, because the whole thing around that is institutional adoption and thinking about future products and funds, right, John? So what are your thoughts around that as it relates to increasing institutional adoption?
So I know everyone is discussing how much new incremental demand will be created from the institution side on the asset class from BTC spot ETF. But I think 2024 will ultimately shape up as a year where the world sees real use cases from business use cases and adoption, and that's how we'll cross the bridge. You know, firms like WisdomTree are already partnering with Ava Labs, and we're creating solutions together. And pretty soon, it's not just conceptual, we'll have numbers to show the benefits of using a blockchain solution in their technology stack.
Right, and of course, Will, I mean, WisdomTree has a dog in this fight when it comes to approval for the Bitcoin ETF.
Yeah, absolutely. I mean, we're a well-known ETF firm. We're one of the 11 firms, I think, who launched a spot Bitcoin ETF. And the good news is they're working like they're supposed to. So these products have been in the market in Europe and other jurisdictions for a while now. Took a long time in the US, but our fund, BTCW, all the funds seem to be working exactly like you'd expect them to, which I think is great. I mean, I think of the ETF as a workflow solution for TradFi investors, financial advisors, whoever it may be, to get access to Bitcoin in the US. It's great to meet clients where they are, but I agree with John. This is just one thing that we're doing, one thing that the industry's doing, and it's a nice moment, but we don't need to spend too much time on it.
Right, and of course, Barnaby, you play in the institutional space, right? So what are your thoughts around the approval for spot Bitcoin?
Yeah, I think it's huge. I mean, ultimately, for me, the challenge so far has always been that there's a gap, a strong regulatory gap, compliance gaps and everything between digital assets and traditional assets. And what this has done and finally bring them together, essentially being able to actually wrap up a crypto asset exposure into an institutional asset class, which just opens the gates wide. And I think it's a massive point of convergence between the two hitherto distinct industries.
Yeah, and Adam, I would argue that it's quite remarkable just how quickly the asset class has matured. It's only been around for 15 years.
Yeah, I mean, I think going back to John's earlier point, once funds like WisdomTree are making money off of these ETFs, it actually improves the long-term health of the network, because they're going to be investing in companies that are going to be bringing more transactions on chain, and that's going to be a net benefit to the long-term health of any of the crypto assets.
Let's talk about tokenization of real-world assets. It seems to me that is the next catalyst really to advancing institutional adoption.
So tokenization of real assets means many things, not just financial assets, but loyalty points and other things that are non-financial. But we're in Nasdaq, let's talk about some of the financial tokenization. I think what you're seeing is there are many firms already out there tokenizing, call it hard to find alternatives that are illiquid. Ava Labs has helped firms like KKR tokenize part of their fund. We've worked with JP Morgan and Citi recently to tokenize FX products, as well as create interoperability of the tokenized HELOC loans from a private chain into a more public chain. So I think it's really happening at this point, but the real benefit, I think, is going to come in almost a year from now, when the rules are a little bit clearer and you can take some of these tokenized assets and actually infuse it back into the system and use it as collateral, similar to an institutional DeFi product where you can use that tokenized private equity fund as collateral, just like you can your house to borrow against it and use that capital. In fact, that's what WisdomTree and Ava Labs have been doing with T. Rowe Price and with Wellington, creating an institutional testnet. It's a valueless token, but we're running the rails, doing the KYC, KYB, AML, and it's a private blockchain right now, but the hope is after all the participants are comfortable with it, they can experiment and they can do things that you would do in a regular DeFi environment, but for institutions.
Right.
Yeah, I was just going to say, I think for me what's so fascinating is that you've got at the moment, you've got all these pools of liquidity, to your point. At the end of the day, you've got, I think, about $12 billion of digital institutional assets in issuance. You've got $100 billion of turnover of securities lending and repos going on. You've got $5 billion of structured products being issued, and you've got 10% of different countries holding crypto assets. The problem is they're all isolated at the moment. So as you said, you know, if you look at the life cycle of a security from issuance all the way through to trading, financing, mobilization, at the moment, digital assets are inferior. But with everything going on in Europe, in Singapore, Hong Kong, and now here, you really get a sense, I bang on 12 months, and you know, there's real progress coming about joining all that up and turning it into a digital asset life cycle.
I think we just need people doing more live products, right? There's been a lot of talk about this for a long time. I mean, WisdomTree is coming to market with our tokenization product, WisdomTree Prime right now, available in 37 states in the US. So I think as more firms like us, other traditional firms, other digital first firms actually start to bring these products to market, you're going to start to see the benefits, but I completely agree.
Yeah, I think one big point though when we tokenize real world assets is going to be the liquidity on them after, and that's going to take some time for it to find its footing. So once it does start to find its footing with products built on top of other tokenized assets, it's actually going to be a net benefit for all of the projects that are currently going on.
100%. I think people think you tokenize something that magically makes it liquid because it can trade 24/7 then. That's not how markets work, right? You think about that with ETFs, right? It's not the ETF, it's the underlying that's the actual liquidity for the asset, right? So I think, and that gets to an interesting point. People started with illiquid assets, but I think with you go liquid first, that's where you're going to see the initial demand, which frankly is what stablecoins are, right? Tokenized dollars in a certain sense, which has been the first real mainstream use case for tokenization.
There's been a lot of tokenization of stablecoins. I would argue that's the first product market proof. Around the world, like there's a lot of, we do Venmo here, but around the world, outside of the US, they're doing P2P using stablecoins, USDT or whatever. And you know, there's been research studies published that there's more settlement on chain than the Visa network, a lot more. So it's being used by around the world.
And that's a great point that you bring up, because we tend to think very US or very Western Europe focused, when the fact of the matter is there's a couple billion people who are transacting using stable coins or other forms of digital assets for a number of reasons. One, cross-border access. Two, they don't have to deal with the crazy fluctuations with inflation that can, you know, your account might look very different today than it does tomorrow. And it's being used, and local digital economies are being built. And we don't want to fall behind that capital market structure, considering how successful the US has been with building traditional capital markets. I mean, you know, people come to list here and then list downtown because we have the marketing, we have the liquidity, everything that supports the financial system. But I don't think we should be short-sighted in recognizing that digital economies are already being built by 2 billion people.
Yeah. No, and I think for me, one of the really interesting things is, to your point, there's quite a lot of markets around the world. The bricks and mortar exchanges are starting to look at, actually, we need to be offering digital assets, not for their own right, but ultimately because we want to chase after the digital liquidity that's locked up in crypto wallets. So, you know, we're getting to this critical mass of digital liquidity or crypto liquidity held in digital wallets that ultimately the bricks and mortars are now chasing instead of the other way around. So you've got this nice inversion effect.
Well, let's talk about that more, bridging traditional finance and decentralized finance. I think we're kind of getting to an inflection point where it's not so much us versus them. That ethos of DeFi is starting to flatten out a bit. And I think a part of that too is how blockchain has matured, because interoperability is key. If you can't interoperate, it's just not going to happen. So I feel like, you know, as long as the technology, the infrastructure is improving, then you have a story.
Yeah, I think the first part is, though, the reason why you mentioned earlier people come to the US to list is we have a very clear regulatory framework around it. In the United States, we don't necessarily have that clear regulatory framework, and it's going to have to change because we have an entire generation that's growing up now that's digitally native. And so everything that they do will be digital first. And so from the perspective of regulations, they have to catch up to meet the new demand that's going to come from the new generation that's going to demand to use these products.
Yeah, and I think legislation or regulation by enforcement isn't the answer either. There has to be some sort of a clear framework, particularly on the compliance side, like you had mentioned before, KYC, you know, financial crime is something we want to be aware of too, money laundering and all that. But I think there are ways to certainly bridge that and form these digital ecosystems.
Yeah, I mean, I think you've only got to look at the big names in terms of like the massive infrastructures. So Swift, DTCC, Clearstream, Euroclear, people who hold the institutional assets of the world, those are the guys that are leveraging the regulatory clearance they're getting from Europe, they're getting from, you know, from the UK, from Singapore, from Hong Kong, and actually really plowing on ahead. You know, you're seeing huge progress being made there in terms of actually, as I said, you know, I think 3,000 contracts have been issued onto Clearstream. So, you know, huge numbers of digital assets, you know, just really because regulatory clearance is there. and you can see the linkage.
I mean, Swift is leveraging blockchain. There was a big announcement last year that they're leveraging Chainlink. From the ETF issuer side perspective, where do you see that gap being filled?
I think it's like the ETF, the Bitcoin ETF. It's like tokenized products are coming to market today. I mean, I think people get a little confused around like permissionless networks versus like where permissioning and rule enforcement and stuff can happen. I mean, I think about these are really just tools that allow financial product providers, consumers to be able to access or use products in a better way. And so I think the regulatory approach to it in the US hasn't always been perfectly clear, but there's actually a lot that you can do within the existing regulations as well. So I think it's just people continuing to bring products to market and not do everything in some sort of big consortia thing, but actually entrepreneurs going out there and putting products to market. I think that's good.
Right, but that's a great point that you make too. And we can also make this argument if you want to talk about cyber for a moment, right? You have the business priorities. You want to get product out there, you want to get revenue. However, there is back testing and security that needs to be done and regs to follow. And while technology moves at a crazy rate, guess what? Especially in the US, we're the most regulated industry. Yeah. So it's not something you can flip a switch at the SEC or whatever regulatory agency you want to call it. And boom, these products are available.
Yeah, but I think for me what's interesting is that all of this is converging, that there's a consultation going on from the BIS at the moment about how much digital assets and crypto assets how much RWA, risk-weighted assets, they should carry. And ultimately it's the first time that the statement of the network is actually a contributing factor to the risk weighting of the asset, which for me is a huge thing because, as you said, cyber is a massive part of actually the risk of holding these things. But we've never asked that about traditional securities. What network is it on? Nobody cares. Suddenly now, actually, it's part of the pricing and part of the actual the cost of carrying these digital assets. And so, these things are actually now all coming into a single rule book, a single codification, which is got to be good in terms of clarity and operationalization.
So when you think about tokenization, let's break it down a little bit here. It might be a rudimentary question. If you're tokenizing an asset, whether it's a financial asset, a piece of real estate, or what have you, is that almost like creating a derivative?
I compare it to like an ETF in some sense, right? Like you think about like what an ETF, stablecoin, whatever you want to, the different things, but like an ETF, right, it's a wrapper of something that exists on Nasdaq, New York Stock Exchange, whatever it is, allows people to buy in the secondary market. They can go in the primary market though to redeem for the underlying, right? So Bitcoin ETF, you go to the primary market, you can redeem for your Bitcoin from the issuer, right? That's what tokens kind of are. They're wrappers that represent something else that could be off-chain. It could be something digitally, kind of on-chain that's being represented this way, or it could be a bond, held at DTCC or things like that. So that's really the best analogy that you have for it. That's really what these products are. They're wrappers.
It is a wrapper, but it's a more sophisticated wrapper.
Yes.
So it allows you to code the business process into the wrapper. You can do effectively active ETF management far easier. You're lowering, costs in terms of providing the product if it's adopted and used properly. Like these tokenization of assets provide 3 value points in my opinion. One is you have efficiencies in the call it the back end, so you're saving whatever basis points on it. Broadridge does 1.4 trillion tokenizing repos for UBS and SocGen, and they're saving millions and millions of dollars for those banks. That's efficiency. That is here. People get that part. It's not sexy in the sense that it's not creating new revenue, but when people have better access to these, because you can fractionalize things or you can take hard to find things and provide access to it and encode the rules of ownership into it, like KYC, this and that, it makes it a lot easier. That's possible. And then the last step ultimately will be that liquidity. I think Adam said it before, it's not going to happen overnight. It will take time, but it's one of those things that it's kind of like an overnight success after 10 years of trying to make it. It's like once it happens, the inflection point is going to be hard and everyone's going to be in there. So if you don't practice for it now, you won't be ready when it's there.
You're saying a lot of TradFi words, right? Liquidity, ETF wrapper, derivatives. It seems we don't have any regulation that exists now that could potentially oversee these types of products, or is it because they can be coded in certain ways that it doesn't fall underneath that one regulatory wrapper?
Well, the regulatory construct we have in our country here is literally 90 years old. Hard to fit a whole new construct into the old ways of measuring things. So it's like classic innovator's dilemma. Like, our strength in this is actually a disadvantage.
Right. Well, I mean, it's a challenge to legislate anything.
Well, I think this is the thing, and for me, the big lesson of the last few years is that you actually have to have the regulators globally inside the tent. At the end of the day, they're working this out as they go along as fast as we are. And I think if you look, what's been great in terms of the success stories is when you see regulators giving people enough space to play, like the EU pilot regime, but ultimately at the same time really engaging and saying, okay, we want to learn with you. Because at the end of the day, the interpretations that everyone brings, the MAS, the HKMA, the European ESMAs, et cetera, they all come at it from a different angle. But I think that team effort has to include the regulators each time.
Yeah, I think that's why, though, we're seeing other countries leapfrog us on regulation, because they didn't have the same regulatory framework on the security side, and so they were able to introduce new regulation that allowed for all these products to enter in much more quickly. So it's going to take time for us to catch up, but I think we will get there. It's just going to take a few years.
You can almost make the analogy, it's almost like infrastructure, right? Places that did not have infrastructure, it's only been introduced over the past 15 to 20 years. They were metro, let's say metro in Singapore as an example. Clearly a very different experience than what you see in New York, because we do have these legacy assets and institutions, so I think that's probably the best way to correlate it. In the last few minutes here, let's talk about short and long-term digital outlook. And Barnaby, I want to start with you, because I also want to bring in carbon markets. That's another new kind of market too that we're trying to navigate and figure out. Yeah, no, look, I mean, I think John, to your point about the value statements of digital assets, I mean, you've got a market, carbon credit markets, particularly the voluntary markets, where 80% of the industry is basically struggling with the cost of a transaction. About the same number are ready to move away from the current operating models, in as much as there are any, in order to get trust and standardization. I mean, those two words are synonymous with everything we talk about in terms of digital assets. So for me, there's a really, really great linkage between ultimately problem statement and solution in digital assets. And I think for the carbon markets, we have no choice. We have to scale those markets by 20, 50 times in the next few years. So we've got to find something that's going to take us up that journey really fast. So that's a correlation almost to what we were talking about before, keeping up with the digital economy and being able to build that infrastructure that has matched the superiority of U.S. global markets. Adam, your near and longer term outlook.
Yeah, I think my long-term outlook right now is mainly based on what we're seeing today. So the advancements that a number of things like the ETFs have caused is actually going to have ripple effects over the next few years that are going to be a benefit to a company like ours that is a mining company. As we drive more transactions on chain, whether it be from companies like WisdomTree investing in companies that are developing on the Bitcoin blockchain or other blockchains, that's all going to start to play out, but it's going to play out over 4 to 5 years. It's not a one-year thing. Everyone wants to talk about price. For companies like ours, we're really excited about what's going to happen 5 years from now to help support the long-term health of the networks.
And Will?
The analogy that we use is we think tokenization is going to do kind of to the existing system what ETFs did to mutual funds, right? Like 20 years ago, mutual funds had trillions of assets. Today, ETFs have overtaken them, taken billions and billions every year, compared to mutual funds, which are largely in outflows. I think a similar, it's just because it's a better technology, right? So I think with tokenization, you're going to see that better technology kind of over the next 10 years really win out, and we'll be talking about it the same way 10 years from now.
All right, and John, last word.
So I think the first thing that's going to happen is tokenization of non-financial assets. We're working with gaming companies. A big part of gaming companies is creating in-game asset marketplaces, but each game is siloed. So if you can bundle different marketplaces to different games, it gives the user a better experience. It's almost like a shopping mall. Bundling businesses actually is a principle that's worked for a long time. Another thing that you'll see is brands figuring out how to turn the NFT construct from just a cartoon to actually better engagement with NFTs are no longer going to be associated with just cartoons. It's going to be associated with engaging with their customers. I was with, so for example, it'd be like a big brand was saying, as soon as the Barbie doll leaves the Walmart shop, they lose full engagement with that customer. So they're trying to create a Fi digital product where there's an NFT associated with that Barbie, and they can now know when they're going to see the movie Barbie. It's not Barbie, but I'm using that example, and they can engage with them. And ultimately, it'll save them a lot of money because they don't have to reacquire the customer through Google or Facebook because they're already engaging with their customers. So literally will affect their income statement in a very positive way.
All right, and we'll leave it on a positive note. Gentlemen, thanks for joining us on Trade Talks. And thanks for joining me from the Nasdaq Market site. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.